Hi, I'm Sophie Taylor, creator of the Taylor Method. How do you save for your kids' college education? Let's take a 529 plan. Now, when you make contributions to this plan, you do not get a tax deduction for your contribution. You do, however, get tax-deferred growth, and if you take distributions for a qualified educational expense, those distributions are tax-free. Sounds pretty good. The 529 plan has its limitations. If you don't use that money for a qualified educational expense, your owner is subject to a 10% IRS penalty if you take a distribution before the age of 59 and a half. After age 59 and a half, those gains are subject to taxation. So what's the alternative? Let's consider a traditional permanent life insurance policy. I don't get a tax deduction for my contributions or the premium payments to the insurance policy. I do, however, get tax-deferred growth, and I get tax-free distributions just the same. But that's where the similarities end. See, whether or not I use that money for a college education, I can take that money tax-free. So what if your scholar doesn't end up wanting to go to college? Or better yet, they get a full scholarship. Those monies can be used for anything, whether it be to buy their first home, open a business, pass on to a loved one, right? So it just gives you more in the way of options. So consider this. When you're filling out financial aid documents, you're asked how much money do you have in stocks, bonds, mutual funds, 529 plans. You're not asked how much cash value you have in your insurance policy. So who's more likely to get the scholarship or the financial aid? The person with money in a 529 plan that has to be disclosed, or the person with cash value in an insurance policy that doesn't? You be the judge. So what's better, a 529 plan or an insurance policy? It really depends on the client and what they're trying to accomplish. For example, if someone wanted to make a contribution one time, right, and they weren't going to make subsequent contributions, I would probably go with a 529 plan. But if someone's going to make consistent contributions on an annual basis, I might look to an insurance policy. Why? Because I have a non-correlated asset class, right? I have an asset that's growing, free of stock market risk and volatility, right? That's typically associated with a 529 plan. So if your client's looking for something that gives them more in the way of flexibility, more of a predictable outcome rather than a probable one, and they want to be able to use that money for tax-free use, whether it be for college or anything else, then a life insurance policy may very well be the way to go.